My number one investment concern right now is that the entire AI industry is being propped up by a complicated web of circular financing deals where all the companies are funding each other. Money is being created out of thin air, and cult personalities are banking on investors to just trust them instead of asking the hard questions. This is eerily similar to a lot of the things Enron was doing before it went bankrupt. To be clear, there was also fraud there, and I'm not accusing anyone of that, but to me, there are far too many similarities to ignore at this point, especially since AI has been driving virtually all of the growth in the economy and the stock market, so virtually every investor has exposure to it. It's kind of like how the Fortune magazine reporter who broke the Enron story described them.
It wasn't clear from Enron's financial statements that there was fraud here, but what was clear is that something didn't add up.
In my opinion, there's a lot here that just doesn't add up. So let's dive into some of the specifics and how they compare to what went on at Enron, which went from the sixth largest company in the US to the largest corporate bankruptcy in history when it collapsed in 2001. At the center of all of this is what Bloomberg calls an increasingly complex and interconnected web of business transactions that's artificially propping up the trillion-dollar AI boom. I think that sums it up well. They put out this chart to try to illustrate it, so I'll reference this throughout the video to help you keep track of all the moving pieces. But to get us started, there are three main types of companies represented here. First, there are the AI labs like OpenAI, XAI, and Anthropic, which somehow didn't make this chart. These companies are the ones that are actually building these large language models. Google does this too, but they're vertically integrated, so they operate in the same business as most companies on this chart, and they're kind of separate from this whole giant web that we'll be talking about today. The AI labs need to run their AI models in the cloud, and that's where our second group, the hyperscalers, come in. The big three are Microsoft, Amazon, and Google, but there are also many other companies that are now trying to get into this business like Oracle, CoreWeave, and Nscale. The hyperscalers can't run AI in the cloud without specialized chips from our third category of companies, the chip designers like Nvidia, AMD, and Broadcom. One of the most obvious similarities between Enron and today's AI companies is the reliance on complex webs of companies and lofty projections based on hopium to justify their valuations and keep the hype going. In Enron's case, it was one of their leaders creating a bunch of special purpose vehicles, or SPVs for short, which were sort of like shell companies if they could sell things to make their sales look better, or transfer bad assets to in order to hide losses.
Fastow created hundreds of special companies to perform a magic trick. Prop up Enron's stock by making its debt disappear.
With AI, it's not quite as hidden, but a lot of similar things are happening. Nvidia just announced that it plans to invest up to $2 billion in Elon Musk's XAI. In total, XAI raised about $20 billion in this funding round, which was split about $7.5 billion equity and $12.5 billion of debt structured via, you guessed it, a special purpose vehicle. And the best part? The SPV will be used to buy Nvidia chips. So think about this. Nvidia is helping fund this SPV, and the SPV will be used to buy Nvidia chips. They're basically buying the chips from themselves. It's not always SPVs, but there is so much of this kind of activity going on right now. These kinds of market risks aren't always obvious, but we can help you find them. Well, that is, if you're subscribed, which surprisingly only about 30% of you who regularly watch this channel are. So what exactly are you waiting for? If you hit subscribe right now, my commitment to you is that Cal and I will do everything that we can to help you significantly improve your life by becoming a better investor. Not just spotting risks, but also opportunities and teaching you how to capitalize on them. Thank you so much for being here. We really appreciate you, and we hope to see you many, many more times. Moving beyond the self-funding SPV, Nvidia has also funded tons of AI startups, many of which rely on their GPUs to run and develop their models. For example, they recently invested in Nscale, which is an AI startup that was spun out of an Australian crypto mining firm in 2023. They're part of a new crop of neo-cloud companies that are trying to compete with the hyperscalers and cash in on this flood of money to build data centers. As of September, they were worth $3.1 billion. The next month, they signed a $14 billion deal with Microsoft to supply NVIDIA's chips, and now they might go public in 2026. which I guess they kind of have to go public for this to work, right? Because where are they going to get the money for all those Nvidia chips that they're going to supply to Microsoft, if not by raising even more money from investors? The chips that they're meant to supply are worth many times more than the entire value of their company. Does this make sense to you? Nvidia also invested in Mistral, an AI startup founded in 2023 that's trying to be the French OpenAI and already has a $14 billion valuation. Nvidia also boosted neocloud company CoreWeave's IPO by taking a 7% stake in it, and then after they owned the stock, they agreed to buy $6.3 billion of cloud services from CoreWeave, sending their stock price soaring. CoreWeave's main business? Basically running out access to Nvidia chips. So Nvidia, the GPU chip designer, is funding a lot of the startups that buy its chips. So a deal with Nvidia boosts your stock price, brings in cash from other investors too, and then a lot of the cash from the investors, including Nvidia, is used to buy Nvidia chips, further boosting Nvidia's stock price. It's a virtuous circle. Well, until it isn't. The AI trade feels a lot like Enron and the tech stocks in the late 1990s.
Even the person with very little disposable income all of a sudden began to play in the stock market because nobody could fail, because stock prices were just going up and up and up.
In a similar fashion to Nvidia, the big hyperscalers are all funding these startups that will use their cloud services. Microsoft, Nvidia, OpenAI, Amazon, and Intel are all among the companies that invested in Figure AI, a robotics startup that is apparently worth $39 billion despite having never made a sale. But don't worry, their own projections say they'll make, $9 billion in 2029. Yeah, that sounds like a company that should be worth $39 billion. Microsoft also just signed a $17.4 billion infrastructure deal with an AI startup called Nebius that also provides cloud infrastructure. Even Nebius's own description on the internet is mostly about all the other companies that it owns or invests in, like AV Ride, an autonomous driving company. I can't imagine that not working out. The reason Nvidia and the hyperscalers are funding these startups is that 80% of the money raised from venture capital, meaning investors in private startups, is spent on compute resources like cloud and Nvidia chips. These companies are, in a way, creating their own customers. It's slightly different from what Enron did because they're not actually creating the companies themselves most of the time, but they are a big source of funding for these companies, and they do often own parts of them. OpenAI is the third centerpiece of all of this, and I might argue the largest of the three. The key difference is that unlike Nvidia and the hyperscalers, who have clear paths to revenue from all of this, OpenAI is burning through billions of dollars per year and has very little revenue, let alone profits. Along with Nvidia, they also own a stake in CoreWeave. They bought in right before the IPO, and then they announced that they had expanded their cloud deal with CoreWeave, whose stock is up over 3x since it went public in March. This is sort of the playbook for OpenAI. Recently, they approached AMD, another chip maker like Nvidia, and they said, hey, we'd like to buy a bunch of your chips. And AMD said, that's great. Nobody else wants to buy our chips, so how would you like to pay for them? And of course, OpenAI doesn't really make any money, so they basically said, well, we were actually thinking we could just announce a deal with you, and that would just raise the value of your company by $78 billion. And AMD said, well, that's cool, but no, you still have to pay. So OpenAI said, okay, how about this? Since we don't have the money to buy your chips, and your chips are still unproven and have never been competitive with NVIDIA's for AI, how about you just give us 10% of your company, then we'll announce a deal, your stock price will go up, so will our investment, and then we'll make enough money to buy your chips. So that's basically what they did. AMD granted OpenAI warrants to give them the right to acquire 160 million shares of AMD stock at 1 cent per share. That's about 10% of the company. The stock skyrocketed when they announced the deal, and now OpenAI's stake is worth a little over $40 billion. So think about it. What's really happening here? AMD is basically buying its own chips for OpenAI since OpenAI can't afford them. The other major GPU designer, Nvidia, also agreed to invest up to $100 billion in OpenAI to help them fund data centers, and OpenAI committed to using Nvidia chips in those data centers. Nvidia is even in talks to guarantee some of OpenAI's loans that it's taking out to build data centers. The day after announcing the Nvidia deal, they announced an even bigger one with wannabe hyperscaler, Oracle. They committed to spend $300 billion on data centers. Oracle will spend billions of dollars on Nvidia's chips in those data centers. So Nvidia funds OpenAI. OpenAI makes a huge deal with Oracle. Oracle will use a lot of that money to buy Nvidia chips. It's the circle of AI. Oh, yeah. And Oracle's hyperscaler competitor Microsoft also has a 27% stake in OpenAI, and OpenAI has agreed to spend $250 billion on Microsoft Cloud over the next few years. In total, OpenAI has committed to spend about $1.4 trillion on infrastructure so far, and a lot of that has come in just the past month or so. There's just one minor issue here. OpenAI doesn't really make any money. Forget profits. They only project their revenue to reach $125 billion by 2029. And that's about 10x more than what they expect in 2025. How is a company with $13 billion in revenue, or even a few $100 billion in revenue, going to spend $1.4 trillion on infrastructure? And the logical next question is, if it can't make the payments, what do you think will happen to all of the stocks of the companies that have skyrocketed when OpenAI's spending commitments with them have been announced? Well, this is another area that reminds me a lot of Enron when they started making huge investments in India.
But Enron had failed to see something basic. India couldn't afford to pay for the power Enron's plant produced.
The reality is that everything behind OpenAI's investments is unproven, and there's a lot that needs to go right for them to be able to meet all of these spending commitments. Just like Enron.
It's what they call in Wall Street a trust me story.
And AI is just like that.
Yeah, we're not built to conceptualize it, but you just have to trust.
I don't know how long this hype is going to last, but the reality is we've seen this story before.
If it's a black box that's there to fool you, the numbers are always going to be good until they're not.
Right now, the media, investors, companies, really everyone is buying in. And the entire industry has been following Sam Altman's lead like he's some sort of a disciple. The Wall Street Journal just wrote that he's effectively convinced Silicon Valley's giants to tether their fates to his company, essentially making it too big to fail, like the banks in 2008. Enron used a similar playbook, just on a smaller scale.
And fixated on a massive public relations campaign to convince the investment community that they were new, different, innovative, almost heralding a new era of corporate enterprise.
I'll say it one more time. We've seen this story before. And so I'll leave you with a key lesson that the Enron crisis and many others have taught us time and time again, but we just keep failing to learn.
Enron hit the national psyche. It hit it as sort of the time-tested lesson, and that is if it looks too good to be true, sometimes it is.
If you want to learn more about the Enron story, I highly recommend watching the documentary The Smartest Guys in the Room, which is now free on YouTube. It's fantastic. And if you want to significantly improve your life by becoming a better investor, hit that subscribe button, because this channel is designed to help you do just that.